This week on Wealth Track, great investor and small cap pioneer Chuck Royce on the historic opportunities available in this underrated asset class.
There's no doubt there's more, and there's more just offerings, period, secondary offerings. Additional capital raise is going on daily. Unbelievable. I have never seen anything like it before.
An exclusive interview with Chuck Royce this week on Consuelo Mack Wealth Track.
Funding provided by Clearbridge Investments, Morgan Le Fay Dreams Foundation, First Eagle Investment Management, Royce Investment Partners, Matthews Asia, and Strategas Asset Management.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Is small really beautiful, or is bigger really better? In the stock market in recent years, bigger has triumphed over small. Relative valuations for small caps in terms of price-earnings ratios are near their lowest in 20 years compared to large company stocks. The small cap benchmark Russell 2000's PE is trading at less than 90% of the large cap Russell 1000's, well below the average 104% premium over the last 20 years. And there's another notable difference in market behavior, this one between growth stocks and value stocks in general, which is quite marked in the small cap universe. Small cap value stocks are selling near their lowest price earnings multiples to small cap growth stocks in 20 years. But what's lost in these comparisons is how extraordinary stock performance has been for U.S. stocks in general, even small cap stocks, over the last 10 years. The large cap Russell 1000 has averaged annualized total returns, that's with dividends included, of 16% plus over the last decade. But the small cap Russell 2000 index has delivered average annual returns of nearly 14%, one of the index's best performances ever. This week's guest specializes in small cap stocks. As a matter of fact, he created the genre. He is Chuck Royce, founder, chairman, and portfolio manager of Royce Investment Partners, an $18 billion value-oriented investment firm, focusing on finding high-quality, small company stocks, selling at a discount to the firm's analysis of their worth. Royce is a pioneer in small cap stocks. He recognized early in his career that there were quality businesses to be found in stocks with smaller stock market valuations, and that historically they outperformed larger company stocks, although as a group they tended to be more volatile. He has been lead portfolio manager of its flagship Royce Pennsylvania Mutual Fund since 1972. Over its long history, Penn Mutual has delivered average annualized returns of better than 13% with below average volatility. Over the last 10 years, it's averaged 12% annual returns. It is currently rated 4-star by Morningstar. Royce Investment Partners has been a Wealth Track sponsor for several years, but Chuck is certainly here on his own merits. I began the interview by asking Royce what attracted him to small caps in the first place and how much the asset class has changed since he identified it 50 years ago.
It was not an asset class. I didn't think of it as an asset class. I just was attracted to the smaller companies that had great potential. Honestly, there wasn't anything like a conversation around benchmarks or asset classes, but I just became engaged in that. Honestly, it just was where the fun was.
And when you describe fun, do you mean that it was where the most entrepreneurship was, or the most owner involvement, or were they doing all sorts of new things, or what was it? What is it about that dynamic?
Well, it was probably the people, meeting these fascinating entrepreneurs. There's no doubt about it that was an attraction. But there was no capitalization range or conversation about what are you doing. We were, in those days, it was, participating in these crazy markets. I started out in 72, and 73 and 74 were disasters.
They were disasters, right.
And then bingo, January 1, 75, the market took off. Thank God, because I'm not sure I'd be here today. The market was up 100% in 75. So anyway, that kind of got things going. I always liked smaller companies, but there was no definition and no one defined it that way. It was more speculative.
Right.
And clearly that's what we were doing.
Now it is an asset class. How has it changed over the years?
Well, I'd say the biggest change was Russell came along and began defining it as a asset class with a definition, et cetera, et cetera. That didn't happen until the mid 80s. And then after that, this whole conversation began to evolve, to migrate, to become a next generation conversation around value and growth, which I happen to dislike as if it's a binary distinction. But that is where the world has gone. And today in the headlines they talk about value doing better or growth doing better, et cetera, et cetera. It's become way too much of a you're either left or right-handed.
And Chuck, it's interesting that you say that, how they, the defined value versus growth, because of course in my introduction to you, that is exactly what I'd have done. At Royce, you're known as, quote unquote, value investors, but maybe you've been boxed in. I mean, how would you describe, your approach at Royce in the kinds of companies that you are investing in?
Well, it's a great question because small cap is so broad and there really are so many ways to make money legitimately. There is a deep value component of people buying for, odd, out of sync valuations. We do some of that. We do a much higher quality value where we require a dividend, and we do lots of that. And then we do a variety of other, what I would call more quality-centric.
Right.
So we do a variety of things. But I don't mind the word value, but I don't like this big kind of binary distinction that you have to be one or the other.
And the other thing that's so interesting about how the small cap universe has changed as well is that I know that Royce is doing a lot of work and investing in international small cap stocks. How did that happen?
It happened very normally. In 10 or 15 years, we began looking at non-U.S. stocks. We'd always use Canadian, we'd always use North American stocks, but we began seriously saying we should apply the same techniques, which was in that particular market was we emphasize very high quality. So we have come to say if we're going to do non-U.S., we must do exceptionally high quality. So we invented a fund that was named after our domestic fund that has a high quality bias.
Mm-hmm. And is that the Royce Premier?
It calls International Premier, yes.
And why are you insisting on a higher quality, a kind of a higher bar for you to get invested in international small cap stocks?
We think a lot about what makes high quality. And of course, the usual things matter, balance sheet, returns, et cetera. But honestly, we're spending our time thinking about whatever features that company has that enable them to get those high returns. We now want to scratch our head and look 5 years, 10 years out and see what could be durable. Mm-hmm. What features are durable. So we spend a lot of time on that, but risk of the enterprise, not all of the companies in the small cap space are high quality. In fact, there's a wide range. 30% of the Russell 2000 don't earn money.
Right. And you're not playing in that, you're not in that sandbox at all.
By and large,
as you said.
No,
right.
No. But it's a huge sandbox, obviously. So the asset class is volatile. We take a risk management approach to the asset class. And that is an important, that runs through all of our product profiles. So even when we have a area where we're investing in riskier stocks, that particular group is still highly conscious of the risk profile and manages it with more sensitivity to volatility and price. Now we have other sort of other zones where we are looking at companies that are exceptionally high quality, where really the risk is a different risk. The risk is one of, are these durable features going to persist? And will whatever the market is saying about those companies, which probably is giving it a high profile, will that persist? So we're making a second sort of a behavioral judgment, which is a different form of risk management.
Another big change that seems to have really accelerated in the last couple of years in the small cap universe is SPACs. So these special acquisition companies are IPO'd, they come public, and many of them in the small cap universe. And what's your view of them?
I don't have a broadly negative view. I sort of, the world does, and you read editorials and you read opinion pieces, and people want to slap them down. But in fact, they're all over the place. I think there's some really bona fide good ones that make their way public in this sort of backdoor way. We wouldn't rule out using them. So it's another form of IPO.
Uh-huh.
Is it tricky? Does it have more risk elements about who gets what fee? Does it have aspects of less disclosure? Perhaps, but I think it's fair, and we would look at these things and have.
But are you looking at them when they come out as initial public offerings, which I think you tend not to buy at a public offering, right?
For a SPAC, we are waiting after they've shaken hands on somebody and after we can get the same level of information that we would hope to have with any new public offering. Now, it's still tricky. We don't know the people. Maybe we're not even, in this world of COVID, we're not even meeting them except over the Zoom. So, there's more risk, but I think it will be here to stay. And I'm not dead set against them at all.
Is there an influx of new companies, new opportunities in the small cap space that is either making it more dynamic or making it more dangerous?
Well, that's a little bit of both,
Uh-huh.
but there's no doubt there's more, and there's more just offerings, period, secondary offerings. Additional capital raise is going on daily. Unbelievable. I have never seen anything like it before.
Really?
Absolutely not. Of company now, they're taking advantage of their stock price, which is up a lot from the bottom of March of 20. So companies are they're building up their balance sheet in a huge way. I guess if I was sitting with them, I would be doing the same thing.
But your companies that you're investing in, is that something that would raise alarms?
By and large, our companies are in great financial shape. Some, build up their balance sheet when they can in order to have that, magic opportunity for a deal. We don't love those things, but it does go on.
As far as valuations, one of the things that really surprised me that I learned from Royce was, how well the small cap stocks have actually done in the last 10 years. Because if you read the headlines, you're thinking, small cap stocks are lagging large cap stocks, and yet the performance has been pretty spectacular, like one of the best decades ever. Are valuations stretched in the small cap world like they are in the large cap?
Well, let's talk in a couple of years and we'll have that conversation.
All right.
Your main point is, small caps have lagged large caps. Well, big deal. The numbers are terrific for everybody. The large caps are up 16%, small caps are up 14%. I mean, phenomenal.
Who's going to complain? I mean, that is phenomenal.
Measured in any way, those
Right.
absolute returns are among the best. It is odd that small cap in this good decade lagged. Now, it is typically not lagged, sort of in each decade. In fact, in all decades, it is not lagged. So it's a little bit of an anomaly.
Right.
But more importantly, every 10 years really has to stand on its own. In the wonderful market we've just are having, we had these super FANGs, let's call them. They dominate the large cap in HAB. Now, they're showing a little, possible stress in all sorts of ways. All it takes is a tiny amount of money to move from this, large cap space to the small cap space to have an impact. I think that will be going on or is going on currently.
There's another divide, which is between value and growth within the small cap universe as well.
Value has underperformed in this 10-year period, rather dramatically, like 400 or 500 basis points. I've always thought of the Morningstar box as missing a third dimension called quality. You have capitalization, value growth, and it's missing quality as a third dimension. More or less, our approach with value is with quality. More or less, quality doesn't do well in the first year of a bull market. In this weird thing that we had coming out of COVID, where there was a scary moment in the middle of COVID in March of 2020, where survival was an issue of many, many companies.
Right,
So
because the economy shut down. Yeah.
the economy shut down. God knows what was going on in the world.
Right.
But the recovery has been dramatic for those companies that survived. In fact, they typically weren't not high quality. So quality lagged, almost rightfully so, because the $2 stock that survived went to 4, went to 8, and returned to survival as opposed to disappearing. Whereas the very high quality small caps didn't go down as much and they didn't go up as much. And quality wasn't worried about surviving. They're worrying about, prospering.
Right.
Quality will do better in this now that we've sort of sorted out the first year. Quality, I know, will do better. I feel much better about how they're performing. And quality, either as a sort of compounder type company or quality associated with value, I feel is the right place to be for the next 2 or 3 years.
And where are you seeing the best opportunities?
In the value zone, we like some banks. We like banks who will benefit by the economic recovery. And there are plenty of growth going on in certain areas of the country. So we're buying quite a few banks in our value portfolios.
Right. And these are regional banks?
Yes.
Right?
There's a bank in Texas called Independence, banks in the Florida area called Home Bank. But we like the better banks that, we look for companies that have high shareholder alignment with us the shareholders. So both of these banks happen to have that. They pay good dividends. We're very comfortable with where they are.
And I'm looking actually at the Pennsylvania Mutual, and I know you've got about 200 holdings in that, so it's pretty well diversified. In your area that you are focused on now, these kind of high quality dividend paying companies, are there some examples in Pennsylvania Mutual?
Sure, we would use those very banks I mentioned. Penn does a little bit of both. A little bit of value. Maybe half is devoted to value. And then we have a group that I'm also involved with that do these compounders.
Right.
In the compounding world, we certainly have lots of exceptionally high quality companies. A company I like a lot is Air Lease. They are a dominant, absolutely dominant leasing company in this crazy industry called the airline industry, a global industry. Most fascinating, they lease planes, they have a highly successful record. They have never had an asset impairment. And it's just unbelievably strong group. They act as kind of a partner consultant with small airlines or not so small airlines all around the world. And they provide a sort of a consultative approach to how they buy their planes.
The diversification approach, because I know you've had other portfolios at Royce that are much more focused. What is the strength of that approach? Why have you stuck with it?
Actually, it's a great question. Very few funds use a big diversification. We have divided up the world, though,
right.
To the very high quality zones and the value quality zones. In that particular portfolio, we have quite a few sub-managers. I'm involved and I lead it, but I have 4 or 5 people that are very active with what we call sleeves. And those sleeves are much more concentrated, and the sleeves tend to mimic what they are doing in their more concentrated portfolios. So it's actually a portfolio of multiple approaches to what I think is almost an ideal way to attack the entirety of small cap.
Except you're not doing international.
We don't do international. No, these are domestic. Now, domestic has loads of global companies.
What kind of environments do these small companies tend to do best in? How do they fare if inflation does, tick up and stay higher for longer?
I think the higher quality companies will do very well.
Because of pricing power?
They are just programmed to do it. That is in their DNA. And I believe that it will be another reason why high quality does well in the next couple of years. They have pricing power.
We ask every guest on WealthTrack if there's one investment that we should all own in a long-term diversified portfolio. What would your choice be for one investment?
I like a company called Quaker Chemical. We've owned it for years, and it's done very well. Last time I looked, we had a 10-bagger on it. It is a company that serves the global steel and other similar industries by providing plenty of chemicals to have their factories run better, quicker, more efficiently. They have had a superb record, and I believe the next 10 years will be as good as the last 10 years.
One of the big trends in the markets in recent years has been the application of ESG standards and environmental, social and governance standards. What's your view of that movement?
We are a long-term investor. A long-term investor had better do their solid work on everything that affects the company. And all of those factors, what the company makes, how they operate, how they govern themselves, and what they stand for with their employees, with their customers, they are critical to a long-term success. So we have no problem with that standard evolving as a kind of public standard. These are basic building blocks of great companies.
Chuck Royce, thank you so much for joining us on WealthTrack. It is always such a treat to have you on, and also to listen to you talk about your passion about small cap companies and your success in them as well. Thanks, Chuck.
Thank you. Great to see you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point continues Wealth Track's long tradition of recommending out-of-favor investments. It is find a top-quality small-cap value fund. Our small-cap pioneer guest, Chuck Royce, has 11 different mutual funds and other products under the Royce umbrella, but there is some healthy competition. Among Morningstar's favorite small-cap value funds is Silver Analyst-rated Boston Partners Small Cap Value, and in the ETF space, gold-rated Vanguard Small Cap Value. Whichever you choose, this is a good time to diversify into this underrated and under-owned asset class. Well, next week we will hear investment lessons from great rule-breaker investor David Gardner as he steps back from his role at the Motley Fool. In this week's extra feature, Chuck Royce shares his lifelong passion for historic restoration with a purpose. There are many communities and organizations that have benefited from his involvement. In the meantime, we hope you will follow us on Facebook, Twitter, and our YouTube channel. Thank you for watching. Have a fabulous weekend and make the week ahead a healthy, profitable, and productive one.